So, welcome to Financial and Managerial Accounting. I'm actually going to skip this video because it's kind of long, but it's just like a welcome to class introduction video, and we've kind of already discussed all that. So, Chapter 1, Accounting and the Business Environment. And this is the book that everyone has, correct? Mm-hmm. Okay, perfect. Our learning objectives, we're going to explain why accounting is important and list the users of accounting information. Describe the organizations and rules that govern accounting. Describe the accounting equation and define assets, liabilities, and equity. We're going to use the accounting equation to analyze transactions, prepare financial statements, use financial statements and return on assets, also known as ROA, to evaluate business performance. Objective 1. So we're going to explain why accounting is important, and we're going to list out the users of accounting. And if you want to follow along in your book, we are in Chapter 1. Which starts on page 1, but you've got to flip a few pages because of the index and everything. So does anyone know, or can anyone guess why accounting is important, or who uses accounting information systems or accounting information?
Pretty much everyone, businesses, locally, government, pretty much everyone needs it to make sure they run.
Banks?
Yeah.
Yep. Yes, very good. True. And yes, sir. And banks as well. Yes. Yeah, you're right. Every business has to use accounting in some form. And we don't necessarily realize it, but pretty much everyone uses accounting in some form. So accounting, and it's in your book on page 2, is the information system that measures business activities, processes the information into reports, and communicates the results to decision makers. So it measures business activities, processes the information into reports, and communicates the results to decision makers. So how would we relate this to our personal life?
For budgeting.
For budgeting? Have any of you ever had to decide whether or not you were going to make a certain purchase? I know Christmas just happened. Maybe, it doesn't even have to be a big purchase. Like, it doesn't have to be like a car. It could even be just, some phones are expensive. So some of us are impulse buyers and we just go and buy it, and then we might regret it later because we realize we shouldn't have. But some decisions we stop and we think about a little bit, and we look at it. I'll just use a car as an example. But we want to purchase this car, and instead of jumping in and just buying it, we think, okay, we're going to finance it, so we're going to have a car note, or we could even buy it outright cash. But because either way, it's going to affect the money that's in your pocket. But let's say we're going to finance it and we'll have a car note. We take into account how much money we currently make, our business activities. We take into account how much money we have. We write this money out onto a piece of paper or something. This is how much money we have or what we expect to make every month. And this is what we already spend money on, our expenses. And then this is what we're left with at the end of the month. This is the information we're going to use to make our decision. Do we buy this car or not? If I have a car note it can only be this amount of money or less. Otherwise, I'm going to have a hard time paying it. So we use accounting in our everyday lives without really even realizing it. For people that aren't accountants, anyways, they may not even realize that they do use some form of accounting. And what it is you're pulling together all this information into one location, reporting it, and then you're making decisions based off of that information that you have. And if you have good information, you can make good decisions. If you have bad information, probably going to make bad decisions. Or if that information wasn't correct, or if you were missing some pieces. So you want to also make sure that the information that you have is as accurate as possible so that you can make a good decision based off of it. So accounting measures our business activities. It processes the information into reports, and it communicates the results to decision makers. So if we're relating it to ourselves, we're the decision maker. If you have a spouse, then you and your spouse are probably the decision makers on a lot of choices that affect your household. If it's a business, those decision makers are more than likely your manager or upper management, depending on the size of the business, or it could even be the owners of the business. And then from there, they make their decisions, and hopefully those are good decisions that will benefit the person or the company. So why is accounting important? So we have this model right here, and I know I mentioned earlier, accounting is not boring. It is not. It is not. But we tend to think of accountants as being boring and dry, and they're always, people tend to think of accounting as, it's black and white. Well, it's not. There's a lot of decision being made in the center. It is most of the time you don't have a completely it's not always black and white. There's a lot of decision that's involved in making accounting related decisions. And so that's what they're showing here. The truth is, this is accounting. So accountants are instrumental in helping to create a prosperous society. So first you've got your economic activity, all the activity that's going on to bring money into the business. There's a lot of gray areas. So like over here, when I mentioned it's not all black and white, most people think that, okay, it's here or it's there, but no, there's a lot of gray. And the gray is where critical thinking, good information, sound judgment comes into play. Accounting judgments. That's the next one right here. So accounting judgments are made based on the information supplied and the decision making. And then we end up with useful information. Hopefully it's useful, and it is useful as long as it's as accurate as possible and relevant. And then from that useful information, hopefully we make good decisions. And if we make good decisions, we can have a prosperous society. If we don't make good decisions, there can be consequences, right? Maybe we have to go back down and relook at everything and make a new accounting judgment. Or maybe we have to go start all over because we realized that the data we had was either not accurate or maybe it just did not fit with the decision that we were trying to make. So let's say we are trying to decide if we are going to get another building, and we let's think. I'm trying to think of something completely bogus. Let's say we are deciding on whether we want to expand overseas or not, but we don't take into account anything, any cost that would be related to expanding overseas. If we don't take into effect any cost that would affect us expanding overseas, what if it costs thousands of dollars or more to expand overseas and we didn't look at that, and now we've made this decision, we're like, oh, it'll be good for the business, we're going to grow, we're going to expand overseas, and then we get up here and we make this decision to do so, and then we are hit with this big huge bill of, oh, well, you were supposed to have, I don't do anything overseas. So, but you were supposed to have all these other things in place and you didn't. So now not only do you have to take care of those things that you didn't have in place, but now you're also possibly getting like lawsuits and stuff from it, or penalties or tax, penalties and stuff like that. So there can be big consequences if we don't pull in all the relevant information possible. Accounting is critical thinking critically, and like I mentioned, there are some decisions that have to be made using good accounting judgment. Let's see. Oh, it won't let me copy it. I can't. Oh, you know what? I can. Where is it? I will go here to our little accounting video. Oh, what? Oh, let me edit it. There we go. So we're going to watch a quick video on accounting. Let's see if I can throw this in your video for reference. Okay.
Think. It's way more important too. And here's why. Let's say you work for a company that makes ballpoint pens. You guys are good at making pens and you're turning a profit. Now, let's say you're in a meeting and someone asks, hey, shouldn't we make markers too? Well, your factory can produce them and your marketing team can sell them. But should you make them? Or should you just keep making pens? Everyone turns to the boss. And the boss, if he's smart, will turn to the accountant. Yep, the accountant. At this point, the accountant might just be the smartest person in the room, and certainly the most important. The accountant will talk with key partners, like the marketing, sales, manufacturing, and finance teams, to determine fixed and variable costs, market size, and potential revenue. She'll build a pro forma income statement to forecast profits and to determine how long it will take to recoup the initial investment. And she'll consider the impacts on the balance sheet that investors use to assess the financial health of your company. Assuming it all looks good, she'll determine that making markers is a sound decision, and then she will tell the boss, very clearly and concisely, to go forth and conquer. It's time to celebrate. You guys are making markers because making markers makes sense, and dollars. Accountants are experts at analyzing complex financial data, making heads and tails of it, and helping business leaders make smart investment decisions based on what the financial data says. It's why accounting is the language of business, and why knowing it can help you become a bigger asset for your company. Ready to add deep accounting knowledge to your bag of tricks? Start here in the top-ranked Master of Accounting program from the University of North Carolina's Keenan.
All right. You're in the better place than that, right? Okay, so that is a little bit about accounting. I hope that helps a little bit. Let's go back to our file. So using accounting, like we've already mentioned, but can help you to make good decisions, better decisions, especially if you aren't. Sometimes it's hard not to be spontaneous. You know, you get this great idea in your head, and you're just like, okay, all you can see is all the positives, right? And you don't see any of the negatives. And then you might jump in there and then realize, oh no, I should have thought this through a little bit more. And I'm not saying that that's bad. Some people, so you could jump in and it could take off, right? It could be great. But if you're able to do some research, put some of your accounting skills to work, look up the information, write down the numbers, figure out your budget, make a plan, you have a better chance of succeeding. So hopefully you'll learn something from this class and it will help you with doing so in your personal life or your future endeavors. Are there any entrepreneurs in here or any people that own their own business or want to own their own business? So you definitely need to pay attention.
Yeah.
Do you currently already have a business or do you have a business in mind?
I'm done logistics, like the whole trucking industry. Basically.
Yeah, which is growing. Yep. Yes.
I do, but you know, while I'm in here learning and trying to get the experience of the accounting, because like you just said, you know, you can go into something that's like, and I really,
Yeah.
yeah.
That is true.
Yeah.
Yes, sir.
I have my own business,
Mhm.
selling cars, tires, apartment, and everything. I need this class.
Good. So pay attention, because it can really help you. And I will say, too, with owning your own business, you need to know accounting because you need to be able to read your own reports. And initially, if you're starting out, if you're just now starting a business, or it's just you or you and a couple of people, you're doing everything. You're all of it. You're every single possible person associated with that business, including the bookkeeper and the accountant and the tax preparer. Well, to an extent. Now, more than likely, you'll probably have someone else file your taxes for you, but you still want to make sure that you have all of that information together for them. It can save you a lot of money. As far as if you know how if you have a good understanding of accounting, it can help you to do your own bookkeeping, or unless you're an accountant, you really don't need to be doing the accounting, but, and it can be very costly. I actually own an accounting business, and one little piece of advice for all the people that do own their own business or want to own their own business: do not ignore your accounting, because there are so many people that I talk to that ignored their accounting or their bookkeeping, and it was like the last thing on their list of things to do, and then they come in and they're getting tax penalties because they haven't filed their taxes, because they don't know what to file for their businesses, because they didn't do their books, or they didn't keep up with their books, or they had somebody do them but they did them wrong, and now they have these tax penalties. Not trying to deter you from owning your own business. Do not take this in that kind of way at all. I am telling you, make sure that you are on top of it. Like, pay attention. And then there's also YouTube videos and stuff like that you can watch that can help you with that kind of thing. But just don't ignore your money. And you don't ignore the money in your personal checking account, right? So don't ignore the money in your business. Don't do that. So decision makers, the users of accounting information. So we're going to talk a little bit about financial versus managerial accounting. Financial accounting is used by external decision makers. These are people like creditors, investors, and what they're doing is they are looking at our financials, they're looking at our reports, and they're determining or deciding whether they want to loan us money, whether they want to invest in our company. Do we think this business is profitable? Do we think this business is going to last? Because you would not loan money to a person who you knew for a fact was not going to be able to pay you back unless maybe they were related to you, probably. I mean, and then eventually you probably would stop loaning money to them because you're just, it's just digging a hole in your pocket. So businesses, especially, they look at this stuff even more because you're not related, right? Creditors, the same thing. They look to see if we think this business is going to make money, if it is making money currently, and we think it's going to continue to make money, yeah, we'll loan you some cash. But if they don't think so, they're not going to loan their money to you because you're a liability, you're a risk, you're at risk to not pay them back, and that may have been a bad investment on their part. Because when you take out a loan, they're kind of investing in you in a sense. They're giving you money, they're expecting you to pay back the interest. So they're throwing you some money up front, and then they expect to make money off you later on. Should we lend? So they're also asking, should we lend the money to the business? Can the business pay us back? That's all external. That's financial accounting and external decision makers. You will have some questions around this, so just know the difference, and that's on page 3. Managerial accounting. If you know what managerial accounting is, you'll know what financial accounting is. And managerial is manager. When you hear managerial, you think inside the company. A manager works for the company. So managerial accounting is within the company. It's your internal decision makers. And the managers, the internal decision makers, they are trying to decide how much money should the business budget for production? Should the business expand to a new location? How do our actual costs compare to our budgeted cost? Basically, what is our financial health of the business? And should we make these decisions for the business? Will these benefit our business or will they negatively impact our business? And these are the decisions that managers are making. Financial accounting provides information for external decision makers, such as investors, creditors, taxing authorities. Investors are people who own a portion of the business, like stockholders. Creditors are people the business owes money to, so they've taken out a loan. And taxing authorities are people who the business owes taxes to, so like the government, the IRS. Managerial accounting provides information to internal decision makers, managerial management. So if you have a question that asks, which ones of these are financial accounting, and you see a manager, that's not it, because manager would fall under managerial accounting. So just kind of keep that in mind. And if you know manager is managerial accounting, everything else falls under this. Managerial, internal, manager. There are different types of accountants. So you have CPAs, CMAs. CPAs serve the general public, certified public accountants. Certified management accountants, also CMAs, they specialize in accounting and financial management knowledge, and they tend to work for one company. So CPAs work for multiple people or businesses. CMAs specialize and tend to work for one single company. You have different types of accounting positions: public, private, and governmental. And this was created in 2016, so these have changed. But they are, pretty similar. But you have here the accounting profession, and then there are different types of positions within the accounting profession. There are actually way more than this. Way more than this. I don't know. I can't really put a number on it, but there's a lot more. But in this example here, we have a controller. A controller is someone who compiles financial statements, interacts with auditors, and oversees regulatory reporting. And then controllers can make anywhere between this particular salary based on 2016, which salaries have all gone up. So financial analysts, they review financial data and help to explain the story behind the numbers. Business systems analysts use accounting knowledge to create computer systems. And this is a good field to be in because accounting information systems and just computers in general, you know, IT is growing as well. So, you know, you put together IT and accountants, that's really good. If any of y'all are interested in anything like that, I mean, depending on the job, I haven't seen anything IT related with accounting that low. It's normally at least like 70 up. So, you know, you can kind of do the math on that if you're interested in IT. Tax accountants help companies navigate tax laws. Auditors perform reviews of companies to ensure compliance to rules and regulations. Cost accountants typically work in a manufacturing business and help to analyze accounting data. And then a paraprofessional or a bookkeeper, they tend to record financial transactions and they help to prepare financial records. Does anyone have any questions on Learning Objective 1.1? Okay. All right. So what are the organizations and rules that govern accounting? This is page 6. So we have FASB and we have the SEC. FASB, the Financial Accounting Standards Board, oversees the creation and governance of accounting standards. And the SEC, Securities and Exchange Commission, oversees our U.S. financial markets. GAAP, Generally Accepted Accounting Principles. GAAP that's the accounting guidelines. GAAP is the main U.S. accounting rulebook. GAAP is created by and governed by the FASB, Financial Accounting Standards Board. And GAAP helps to provide useful accounting information. It must be relevant and faithfully representative. And GAAP is a pretty big deal. So definitely just come back and review this slide. Slide 15, and it's on page 6. The economic entity assumption, an organization that stands apart as a separate economic unit, follows the economic entity assumption. So some types of business organizations, some examples of this would be a sole proprietorship, a partnership, a corporation, a limited liability company would follow the economic entity assumption. And so here we have more of a breakdown of that economic entity assumption as it relates to business organizations. So for a sole proprietorship is a business with a single owner, sole meaning one owner. Number of owners, it's one, and that's called the proprietor. The life of the sole proprietorship will terminate when the owner chooses to close down shop or when the owner passes. And the personal liability of a sole proprietorship, the owner is personally liable for anything within that business. With a partnership is a business that has two or more owners, and It's not organized as a corporation. So number of owners, 2 or more, they are called partners in a partnership. And a partnership will terminate at a partner's choice or when they pass. Partners are personally liable for the business. A corporation. A corporation is a business organized under the state law that is a separate legal entity. In a corporation, you can have one or more owners, and the owners of a corporation are the stockholders. The corporation's life can be it's indefinite, so forever. And then a corporation, stockholders are not personally liable. In a limited liability company, an LLC, a company in which each member is only liable for his or her own actions. So in an LLC, each member is liable only for their actions. You can have one or more owners, and if you have more, then they're called members or partners. So if you have more than one owner, you can call them members or partners. The life of an LLC is indefinite, and members are not personally liable. As far as taxation and the type of business, a sole proprietorship, they do not separate taxable entities. So the owner pays tax on the proprietorship's earnings. And this is normally a small business. In a partnership, the partnership is not taxed. Instead, the partners pay tax on their share of the earnings. So if one partner has a higher share of earnings, they're going to pay more taxes than the other partner who has a lower share of earnings. And then for a partnership, these types of businesses are normally professional organizations, physicians, attorneys, and accountants. A corporation, they are taxed, they're separately taxable, and the corporation pays the tax. And these are normally large multinational businesses. And then for the limited liability company, the LLC is not taxed. Instead, the members pay tax on their share of the earnings. And then for the type of business, this is an alternative to a partnership. So a lot of times people will decide, like depending on the type of business, but partnerships and LLCs are normally compared a lot to try to figure out which structure would best suit the business that the person's starting to get into. So GAAP. And by the way, all of the business organization information is on page 7. So with GAAP, we have economic entity assumption, cost principle, going concern assumption, and monetary unit assumption. And so the economic entity assumption on page 6, the economic entity assumption is an organization that stands apart as a separate economic unit. So there's a little more information listed here in the book if you wanted to read up on that.
What page is it?
On page 6. And then the cost principle, that's on page 9. The cost principle states that acquired assets and services should be recorded at their actual cost. So basically saying that we're recording things based on what they actually cost, the cost principle. Going concern. Going concern assumes that the entity will remain in operation for the foreseeable future. So we assume the entity will remain in operation for the foreseeable future, going concern assumption. And then the monetary unit assumption is the assumption that requires the items on the financial statements to be measured in terms of a monetary unit. So we are measuring we're measuring things based on their monetary unit. So International Financial Reporting Standards, also known as IFRS. IFRS is a principle-based standards. It's used or required by more than 120 nations. It's published by the Internal Accounting Standards Board, also known as IASB. Ethics in accounting and business. So for example, an audit. So an audit is an examination of a company's financial statements and records. So an audit is when we're looking at what they did and seeing if it was done accurately. This is also where fraud is found a lot of times. And then Sarbanes-Oxley Act, SOX, requires companies to review their internal controls. And internal controls are in place just to try to limit and reduce fraud. So, does anybody have any questions on Objective 1.2 right now? Okay. All right, so we will go ahead and move into 1.3. Yeah. All right. So describe the accounting equation and define assets, liabilities, and equity. So what is the accounting equation? This is on page 11. You have to know the accounting equation. You have to know it for every other class after this. And it will also help you in your personal life as well if you know what the accounting equation is. So the accounting equation is assets equal liabilities plus equity. And give it that lighter color. No, not that. Just mark through it. We have to see it. How do you undo? Where's my eraser? There we go. Go away. All right, so this is the accounting equation. I'm not going to do that again. I'll use a different, so it's easier. The accounting equation is the basic tool of accounting. It measures the resources of the business and the claims to those resources. Remember, the accounting equation is an equation, so the left side of the equation always equals the right side of the equation. Assets always equal all of your liabilities plus all of your equity. Left always equals right. And write this down if you didn't. So here we have one more video that we are going to watch on the accounting equation. And let's see. Let's go here. Put that in there. Pause. Let's put this in our video, just in case you want to refer back to it. All right, and
Debits and credits explained. Assets are things that you own, like heavy equipment, cash, and real estate. Liabilities are things that you owe, bonds owed to creditors, and potential damages from a lawsuit. Stockholders' equity is who owns the company. It's also called owner's equity or capital. Assets equals liabilities plus owner's equity. This is called the accounting equation. What the company has belongs either to the creditors who hold the liabilities or the stockholders who own stock. Revenues are inflows from customers. Expenses are the costs of bringing in those revenues. There are different things the company has to pay for in order to make sales and profit. Sometimes they're a little too high. Revenues minus expenses equals net income. Net income is what most business people are looking for. Now, net income belongs to the owners. Assets equals liabilities plus owner's equity. Net income belongs to the owners. Therefore, net income will flow to the owners. This could be shown a different way. Revenues go to the owners. Expenses come out of the owner's share of the company. We could rearrange all of this like so. Assets on one side, liabilities and owner's equity on the other, where revenues flow into owner's equity and expenses come out of owner's equity. If I want to express this without a subtraction, I can simply move expenses to the left side so that assets and expenses equal liabilities, owner's equity, including revenues. This is debits and credits. Debit accounts are assets and expenses. Credit accounts are liabilities, owner's equity, and revenues. It's extremely important to understand which accounts are debits and which accounts are credits because they're treated in opposite ways on the books of the company. A debit account such as cash is going to be debited. The number will be written in the left column in order to increase it. To decrease it, it will be credited. The number is written in the right column, the credit column. On the other hand, credits, such as bonds payable or liability, to increase them, you will credit them, write the number in the right column. To decrease them, you will debit them, write the number in the left column. If you accidentally debit a credit account or credit a debit account, the amount will go in the wrong direction. Check out my website at accountinator.com. It's do-it-yourself.
So hopefully that helps a little bit, and we'll discuss that more in detail. Let's see here. All right, so that's where we were. So assets equal liabilities plus owner's equity. That's our main accounting equation. And if you look on page 13, you'll see that equation, and then they break it out a little more like what was referred to in the video, where it says we've got assets equal liabilities plus equity. And then underneath the word equity, they break out equity, what is also falls within equity. So contributed capital, common stock, dividends, revenues, expenses, retained earnings, all fall within equity. And we will learn more about all of that. So just know that this is where page 13 is where you can go to reference that equation and see the broken down version of it as well. So an asset, this is on page 12. An asset is an economic resource that is expected to benefit the business in the future, something that will benefit us in the future. Cash, merchandise inventory, furniture, land. We expect all of these to benefit us in the future. And these are all considered assets. And just also keep in mind what examples of assets and liabilities are, because these examples, let me go back. These are accounts, right? So when we looked at our assessment earlier, we had an account on there that said cash. So now we know cash is an asset. And assets, he just mentioned in that video, assets are debits, right? So we know, you can write this down on your paper or next to your book, but we know asset is cash and cash is a debit. The normal balance is a debit. So just know that. And actually, since assets, normal balances are debits, we know all of these normal balances are debits for every account listed here. So if we have an account for furniture, I can't remember if there was one on there for furniture. For like inventory accounts, land, all these, they'll be debits. And that just means that when you go and you're filling out your T account, the balance in that account is going to go on the debit side.
So is it debit or debt?
Debit. Debit.
Yeah, you said debt, right?
Debit.
Debit.
You know what I'm saying? Okay.
So remember, so we have, so this is a T account. And since we're talking about cash, and they just told us about cash, I'm just going to write this on here for you. So this is our cash T account. And cash has a normal balance, a normal debit balance. So if we have cash, it's going to be on the debit side. And then, let's say we use some cash. Now we have this much cash. Yes, ma'am.
So debit is basically either the money that you have or your income, and then credit is the expenses that you have.
That's a liability.
No, it's a little tricky. So we'll talk about all of that. Just know that the normal balance, and you can pull.
We're
I
learning the
might have-
lingo right now, right?
I'm sorry.
We're kind of like learning the lingo. more.
Yeah. So just go slow. I think I might have I have a little cheat sheet. Like, it's not a cheat sheet, but it's like, a little, it's something that I actually bought when I was in accounting 202. But it still works. It's not outdated. I mean, it's old, but, and I have it, let's see, I wonder if, it might not be on here. I might need to add it to this class. Yeah. Okay. So I'll have to add it. It's not currently on there. Or I'll send it out in an email, but it kind of, it gives you examples of, some of the most common accounts like cash and inventory, and it'll tell you what their normal balances are. You can also pull up normal balance if you Google normal balance on accounts. The normal balance is the balance that it should normally always have. So the balance of cash is a normal debit balance. It's a normal left balance. So cash should always normally have an amount on the left side. Right. Some accounts have a normal credit balance, and that just means the complete opposite, that their normal balance will be on the right side. And we'll talk more about this again, but it's not like you would think of your bank account. It's not like a bank account. So just don't think about it like that. Liabilities. Liabilities are debts that are owed to creditors, and many liabilities have the word payable in their title. And liabilities have a normal credit balance. So, accounts payable. This is a very common liability account. So, accounts payable has a normal credit balance. So, their amounts would fall over here. It's just opposite. This is an asset. This is a liability.
So that's like
Oh.
rent or whatever, like say if you have a car that you're trying to like pay off or something, then that's where.
Something that you owe. Yep.
Okay.
Now, this is an asset, this is a liability. So we have our accounting equation, which is what assets equal liabilities plus equity. So cash is an asset, our cash account, our asset account has $50 in it. Accounts payable is a liability. It has $50 credit in it. So that's 50, 0, 50 equals 50, both sides equal. Assets always have to equal liabilities. And just remember, this is where your debits, that's the debit side, and that's the credit side. It'll all make more sense. I don't want to say too much. I feel like I may have just said too much just in that. I don't want to overwhelm you.
So basically, when we do our assessment, both numbers on both sides should be the same.
On the equal sign. So whatever's on the left of the equal sign should equal everything on the right of the equal sign in total.
Okay.
Yeah. So examples of liability accounts, normally they always have the word payable in them. Examples are accounts payable, notes payable, salaries payable, wages payable, taxes payable, just goes down the list. And that's your liabilities. And I think you do have some liability accounts on the assessment as well. So just refer back to this slide. And this is, let's see, page 12. And then equity. So equity, this is the owner's claims to the assets of the business. The owner's claims to the assets of the business are called equity, which is also called owner's equity. The owner's claims to the assets, like our cash, for example. Increases in our equity will result from owner contributions, so owner's capital account, or increases in revenues. This will increase our equity account. Decreases in equity come from when the owner makes withdrawals, there's dividends, or if there are any expenses. Expenses will decrease equity. Like we saw in that video a minute ago, revenue and expenses fall within equity. But revenue, most of us probably know revenue is like income. It's money that we are making, and expenses is money that we're paying out. So how can both of these be in equity? Because we're taking our revenue and we're subtracting out the expenses. So that's something that's kind of confused people, and that's why I'm mentioning this. And you'll see on this next slide, this is a good slide to refer to.
So it's not like you're only recouping off of what you're making money from the revenue?
Well, I think what confuses people is normally you're adding, but when it comes to expenses, expenses falls under equity, but you're subtracting it out. I think that might be what confuses people normally, because normally you're adding things, like you're adding all your liabilities. So you have accounts payable plus accounts receivable plus accounts, not receivable. You have salaries payable plus notes payable under your liabilities. You're adding all of those payable accounts. In assets, you have cash plus accounts receivable plus other asset accounts. You're adding all of those together. But when you look at equity, you'll have revenue minus expenses. So you're not adding every account that falls under equity. Some of these accounts are being subtracted out. Like this one and this one. They're both being subtracted out of equity. So the main accounting equation is assets equal liabilities plus equity. But then If you're given a problem and they don't say equity is, they say owner's capital is this and owner withdrawals this, then to find the equity, you would take the owner's capital minus the owner's withdrawals and get the equity. If you had a question that said revenues equals this and expenses equals that, you would take your revenues minus your expenses to get your equity, and then you would complete the rest of the equation. And we'll have some examples and stuff. But just kind of pointing out that owner withdrawals and expenses are two items. Those are accounts that would be subtracted from your equity amount. So net income. Net income is when you have revenues that are greater than expenses. So when your revenue is more than your expense, you're left with some money. You have some money. That's your income. That's your net income. Whatever is left after you pay out all of your expenses. If your revenue is less than your expenses, you have a net loss. You spent more than you made. So now you're at a net loss. You'll have a negative number. And it can happen. You can spend more than you make. So, I mean, if you don't think of it in terms of cash, like, okay, well, you have $200 cash and you spend $200 cash, how are you going to have a net loss? You're just at zero. But there's loans and payables. Maybe you purchased some stuff on account. So you went and you got a computer because you need a computer for your job. You got a computer and they said, hey, you can go ahead and have the computer now and you can start paying us in 60 days. Well, you got this computer, but you don't have the cash to pay for it. You can have a net loss. Does anyone have any questions on 1.3? Yes, ma'am.
So I would have thought that expenses were part of liabilities. I don't know. What is exactly an expense? Because I really felt like this that you said, like accounts payable, that would count as expenses too.
So liabilities, so on page 12, so liabilities are things that we owe. So like accounts payable is where we owe money to something, so to someone. We owe money to someone, but we haven't paid it yet. It's accounts, so it's a payable, we haven't yet paid it. Whereas expenses are after we've already paid that out. Expenses is normally the cost of selling our goods or services. So if you look on page 12,
So basically, like, say if you're a clothing company, everything that you spent to make the clothes, that's what you're looking at.
for expenses.
Yeah.
Mhm.
Okay.
Yep. Yeah.
That's why it comes out of the revenue to like restock.
Yep.
Okay,
Because the revenue is what you're making off of it and the expenses are what you're spending on it.
okay.
Perfect. And then payable is, something that you owe. It could even be like a creditor. Maybe you took out a loan to start the business. Your note payable would be listed under the payables and the liabilities.
Okay.
Yeah, perfect. Does that answer your question? Okay. Any other questions? No? Okay. Let's see. Do we need 5 minutes? Okay. So we'll do a 5-minute break and then we'll jump into 1.4.